This is the daily fiscal pulse for the 17th of July, 2026. We're looking back one day at how the money moved through Friday's close. Before we dig into the numbers, let's acknowledge what's capturing attention across the markets. The story right now is all about AI and tech. We're seeing significant coverage around the Trump administration's head of AI safety agency stepping down after just 3 months in the role. That narrative is clearly bleeding into market behavior. With that context in mind, let's see what the fiscal data actually tells us. The headline number on flows is a net transfer of $5.7 billion. Standing alone, that's reasonable enough. What matters more is the direction we're seeing over the last 5 days. That flow has dropped to roughly half of what we've observed in recent weeks. The main culprit here is tax receipts, which landed at $10.6 billion and account for most of the movement. The ES chart reinforces the same message. Futures ended the week at 7,497, sitting meaningfully below the 20-day moving average of 7,530. The 20-day range spans 267 points and has been moving downward. So the picture from flows and price action is aligned on this one. When you zoom out, the deceleration becomes unmistakable. Government spending averaged $4.9 billion per day over the last 5 days. Compare that to the 20-day average of $13.6 billion, and you're looking at a clear pullback. Less liquidity is entering the system overall. Fewer dollars flowing through households and into the financial markets. The result is tighter financial conditions. Year over year, the situation hasn't shifted much. Spending sits at $1,303.7 billion with essentially no change from last year's pace. There's no material uptick in fiscal support to point to. For those tracking the long side, the fiscal backdrop is worth considering. The current fiscal conditions gauge reads -77. That said, history offers some perspective. We've faced similar setups repeatedly, and despite tighter liquidity, the S&P has still managed an average gain of around 1.5% in the following month. Liquidity and market direction don't move in lockstep. Equities can still grind forward. Positioning deserves attention though. Leveraged funds have been adding to long exposure while margin debt sits at the 100th percentile. That's a high watermark. Historically, these elevated levels tend to function more as a caution signal than encouragement. This is where the pieces fit together. Fiscal flows are running lighter than last year, which means the shock absorption capacity in the market has diminished. When sentiment turns positive, equities can still climb. But when something shifts, like tensions escalating in AI and tech, the downside can accelerate. There's simply less liquidity underneath to cushion the blow. 2 items on the calendar worth watching. The 22nd of July brings the Social Security payment cycle, the 4th Wednesday of the month, and that can reshape the flow picture in the near term. Then we've got the next major Treasury coupon interest payment window arriving around the 15th of August. Fiscal drag is clearly visible in the data, but the rate at which tightening is occurring might be stabilizing. What happens next likely depends on how these scheduled payments end up flowing through. That's the setup we're working with.